Hello again, welcome back. Another video in which I'm gonna be using my awesome voice as it has been affected by COVID, and hopefully it's gonna be a little bit better in the upcoming days. But you have to excuse me for this kind of voice that I'm having right now. Again, I have been affected by COVID, feeling a little bit better. I'm actually feeling significantly better than the previous days. And so hopefully I will be able to go back to my normal and be able to continue making all the videos that I was making before I was struck by this damn thing, and now I can go back to making quite a few videos about the stock market, which I love doing so. And let's take a look on Shopify today. And Shopify has been crashing insanely today after it has reported earnings, and it's down 17.27% right now, as you'll see. And we have made videos about Shopify in the past, and I have long told you that you need to be patient about Shopify. And I have talked about how I would like it to have a steep decline before I would even think about potentially buying it. And some people back then were saying that it will never go that low. Yet, as you'll see right now, it keeps on tumbling, and this may become a possibility. And so, let's take a look at the stock news, and eventually, we will also analyze the company and see what kind of price we want to be getting. Now, you will see stock plunges 20% as Shopify spooks Wall Street with Q1 results. Let's take a look at what happened here. So they reported 2022 earnings, of course, and they have been on a downward trajectory, of course. So we have made a few videos about it. It's been going down and down and down over the past 6 months. It's about 73% down, as the article tells us right now. I just want to take a quick look at our stock analysis chart, which will be super precise. And yeah, it's 77.2% down in the last 1 year. Insane. So, what's happening with stock? Shopify's earnings report fell short of predictions here. It reported adjusted earnings of 20 cents per share after analysts predicted 64 cents. This is, of course, obviously an insane miss here. Although revenue growth year over year reached 1.2 billion, which is an increase of roughly 22%. So revenue increased, but adjusted earnings much lower than the predicted 64 cents, significantly lower. And after rising in anticipation of the report, then the stock fell sharply, and it's down 20% right now. And the article pretty much continues and talks about how what this means potentially for the industry and all that. But what I want to do is take a look at the actual company and try to determine whether this is an interesting opportunity. Because as the stock tumbles for missing on earnings, for instance, this could be a very nice opportunity for us to grab it at a much cheaper price. Because a company will have bad earnings reports, will have bad periods, bad quarters, especially when we're at an economy that has been on life support, really, with all these lockdowns and all this helicopter money. You can expect many companies to go down in terms of function, in terms of how much money they are making, and more than likely this is going to be temporary. It could last for maybe, I don't know, a few months, a year even, but eventually, as we exit the slump, I'm pretty sure they will go back to normal. It may last even a little bit longer. It really depends how the Fed is going to handle interest rates, and whether there are going to be senseless lockdowns again, and again money for no reason being distributed to people. This is what is causing the flame in the economy. This is what has caused the vast majority of what we are witnessing right now. And so, if the Fed goes back to normal policies, and they do have to raise interest rates, and they keep on raising interest rates, and they eventually tame inflation, and again stop giving away money for no reason, and stop with ridiculous lockdowns, then I'm pretty sure eventually we will go back to normal. And you will see some of these companies that have been completely annihilated potentially go back to profitability, and even if they are profitable, potentially go back to what they were doing before this kind of slump occurred. And so the P ratio of the company is sitting at 21. Now, of course, this is dynamic. As the price is going down, this is going to be affected more and more. The price to free cash flow ratio is still relatively high. But again, another dynamic index here that is going to be changing with all this massive drop down. This is probably going down. This is why the stock evaluation tool is going to be the best one, because this is getting too volatile right now. It's going to be changing its metrics pretty much every day in terms of the price of the stock having such difference really day after day. But the outstanding shares of the company have been increasing, so the company has been diluting investors. They will likely not continue on this pattern because the stock has been going down. And so I'm assuming that they may stall their issuance of shares here, just because it doesn't make too much sense to keep on selling shares that are not worth that much as the stock price is going down. And you will take a look at the market chart here. You will see the amazing crash that Shopify has had to withstand so far. And the company seems to be having enough free cash flow to be able to sustain their total liabilities. And the revenue growth of the company has been increasing, net income growth also increasing, free cash flow growth increasing as well, and total equity growth likewise increasing. So the company is a growth story, which is nice to see, of course. Yet also having some very nice net income margins and returns on equity. So these values are actually very, very promising here. I like what I'm seeing a lot. And what I really, really want to see here is what it plays out in terms of the stock price. And so I am expecting the company to continue increasing their revenues at a high pace. And so I can't really use averages of like 50 or 40% here, but I can definitely try something like, let's just say 17%, and then go 20 and 23 maybe. After all, we're still much, much lower than the current revenue growth, with the 5-year average having been 65%. The net income margins here, the 5-year average has been 11%, about 22 and 63. And you can see those here. It has been negative in some years before, and it's basically the fiscal year 2021 that was good for the company. Yet we cannot go that high, of course. I think I'm gonna go 8, 10 and 12 here. The free cash flow margin that I'm going to use is going to be around the 50% level. It looks like it would be fair because the company has been having some slumps. I'm gonna go 50, 60 and 70 and place a little bit of faith that the company will be able to convert a lot of their net income to free cash flow, 70% being my highest estimate here. A little bit of a leap of faith here, by the way. Annual return of 13% is what I typically like to make, because I can make 10% out of an S&P 500 ETF, at least when the stock market is not crashing as it is right now. Actually, it's regardless of this, because when we're talking about 10% of a gain for an S&P 500 ETF, we are including any market crashes that have happened for the last century or so. So 10% does include crashes as well. Calculate. And when we hit calculate, we are looking at the company's current price, which is highly elevated and much more than what we would like to see, even for our high estimates here. They are $105 and our current price is $400. And you can see that even the company's stock, even though the company's stock price has been completely annihilated, the company's stock still looks very expensive for what it is. And this is why, even though again the company's stock looks like it has been battered down immensely, I still think that the price of the stock is very expensive for me to hold, and I'll have to wait a lot before I would be potentially a buyer of Shopify right now. It would have to drop a lot, probably around the $100 mark, for me to consider adding this to my portfolio. And yes, it may never happen, but the same thing you could have said here, or here, or here, and yet we're still going down. So we'll see. Thank you for watching the video. Let me know what you think about Shopify. Are you a buyer? Are you a seller? What are you doing with the company? And again, thank you for watching this one. In the meantime, take a look at this other video that I made today with my awesome voice again. This was about Alibaba and the Chinese stock market, why things are going down, and what what we expect from this, how we expect this to continue in the next few days or so. And thank you for watching this one again. I'll see you in the next vid. Bye bye.